Great. Let's welcome in a very, very special guest now. Prashant Khemka of WhiteOak Capital is now with us. Prashant, you track global markets pretty closely because of the flows and the sort of nature of investors that you have. Can you just talk to us about what's really worrying the markets? What are markets trying to price in when you're seeing this reset?
Certainly. So see, over the last 2 years, the world has, gone from a demand shock. So post-COVID, the dramatic fall in the market was on worries of demand shock or demand disappearing because of COVID. Everyone was expected to, be restricting their travel and all other activities. And possibly stay locked up at home for extended periods of time. And in such situation, it would have been a massive hit to demand globally. And hence we saw oil price going even on a spot basis to negative because the worry was, where would all this oil go? People would have to store this oil, and storing the oil costs a lot of money. And so these spot prices went negative. Today, what we have over the last 2 years, then, the demand never disappeared. The demand shock never materialized. And today, what we are seeing since the start of this year, particularly after the geopolitical situation, Russian invasion of Ukraine, what we are seeing is worries and fears of supply shock. So supply disruption was already ongoing because of COVID. While demand didn't really disappear, but supply certainly got disrupted, as we are all very well aware, with shipping containers shortage because the freight ships were taking much longer to clear at docks, as one example. Then mining output suffering because of the pandemic and the restricted labor supply and so on and so forth. The supply that was already disrupted coming into calendar year 22. And on top of that, forget supply disruption, there was a supply breakdown because Russia and Russia and Ukraine put together are very large supplier of commodities, of metals, of oil, gas, and also agri commodities. So that supply shock has meant that the world is now worried about inflation because demand hasn't slowed down commensurately and supply has collapsed. So from a deflationary environment or worries of deflation 2 years ago, we are now in the midst of heightened worries about inflation. Remains to be seen how this actually plays out. Just as 2 years ago, the demand collapse situation didn't play out, we'll have to see whether the supply remains so constrained as it is now or improves. But that is what currently the market is definitely preoccupied by and most worried about.
Hi Prashant, this is Anish also joining in the conversation. Well, point taken what you're talking about the macroeconomic situation, but in the earlier cycles of recession, we had seen that central banks would come in and printed more money. But this time around, inflation is the real problem. So how do you expect central banks to manage it, and what kind of reaction you're expecting from the markets to that?
See, first of all, I'm not necessarily in agreement with the assessment that is universally accepted that in the past few cycles, the central banks have somehow saved the world and maintained the high growth scenario going and all that. I think that's a very simplistic assessment. Central banks, I don't think, are as powerful as they are given, for lack of a better word, credit for. I think inflation expectations for a very long time have been very muted. And for reasons, inflation expectations have been declining for the last 40 years, more or less, with some intermittent, it hasn't been a straight line. There have been intermittent ups and downs, just like we are in the midst of inflation spike, if you will. If you look over the last 40 years, there have been several inflation spikes along the way, but almost pretty much since 1980, inflation expectations have been on a decline. Obviously, during COVID or at the start of COVID, the expectations nosedived, and since then they have been coming up to more of that longer term trend line. If for whatever reason, if inflation expectations are lower, which has been the case, and declining, which has been the case, that has prompted longer term interest rates to be lower. So I'm not talking about interest rates over the next 3 months or the year or 3 years even, but the 20-year, 30-year, if you look at the 30-year bond yields and all, has been in a decline for a very long time, over the last 4 decades, and that has more to do with longer term inflation expectations. Now, if the world continues to evolve in a manner that these inflation remains sticky for longer, and that then has impact on long-term inflation expectations, and then that has an impact on longer-term bond yields, then yes, and if there is no commensurate economic growth to support valuations, then yes, the market can remain choppy or be capped on the upside or have further downside if we are in that kind of situation. Right now, what you're seeing is, near-term inflation is certainly spiked up, but it's certainly not translated into long-term inflation expectations rising to any material degree.
Prashant, we've spoken about IT earlier and how you've been overweight on a lot of mid-cap IT companies when the valuations were getting re-rated. What do you make of some of these IT companies now getting derated? Numbers are decent, but still, stocks are getting derated.
No, certainly IT has this year taken the brunt, if you will, of the market correction. And I think it's in part because of the worries of global slowdown due to these inflation worries or geopolitical worries. And if global slowdown were to take place, then global demand for all kinds of products and services might go down. And the fears are that IT spending at larger firms, Fortune 1000, Fortune 500 firms, the IT spending budgets can be curtailed this year. It is very possible that such scenario does evolve. Markets are always, ahead of the curve on these things, though as of now, there is no tangible sign of any of such things occurring. But if the geopolitical situations were to worsen or globally slowdown was to accelerate, then it is, very much possible that might happen. So we remain, invested in these select IT names, and just as we were a year or 2 years ago, we even today don't take such top-down sectoral calls. 2 years ago, also we had IT services. 4 years ago, also we had IT services. But at the same time, we also have banking sector names, right? So we have a good lot of investment in private sector, financial sector in India. So that to have a balance in the portfolio is very essential. At any given point in time, certain sectors would be in favor, certain sectors would be out of favor. Our idea is never to try and make money from sectoral calls, because we believe it's impossible to make money by top-down calls on the market or on particular sectors. But if hypothetically speaking, that is not the case and cannot be consistently the case, but if hypothetically speaking, you own individual companies in every sector that can outperform the sector over any reasonable time period, then collectively as a portfolio, you should be able to outperform the market. So that is the perspective that we come from, rather than coming from a top-down perspective that now IT sector would do well or now commodities would do well. But yes, given our investment philosophy and the kind of companies that or the attributes that we look for in companies, sectors such as private sector financials, IT services, consumer, healthcare, and both consumer staples as well as discretionary. These are sectors where we tend to find more opportunities most of the time structurally, rather than sectors like utilities, energy, commodities in general, where we struggle to find great opportunities. We do have investments to some degree or the other, but these sectors tend to not present as many attractive opportunities given the way the investment team thinks and approaches investing.
Okay, Prashant, we'll let you go on that note. Thank you so much for joining us with that take. So you believe that there is no tangible sign of a slowdown when it comes to the IT spend so far. You remain invested in selective IT names and you're seeing some opportunities in private sector financials, consumption and healthcare sector as well. Thank you so much for joining us. But on that note, we are slipping into a very short break.